Okay, good afternoon, everybody. Thank you very much for taking some time out of your day to join us this afternoon to kind of take part in the masterclass and hear from our program co-directors, Amir and Kern. So just a few little housekeeping bits. So this will be a fairly interactive session. So if you do have questions that you would like to address to either Kern or Amir, please do either pop them in the chat or raise your hand, and you can do that in the participant section, and we'll do our best to address your questions as we go, rather than doing a large Q&A session at the end. There will be time for that at the end, so we'll make sure that we have time at the end for you to address any questions to our program directors. But with that in mind, I will turn over to Amir, who's going to kick us off and take us through the bulk of the session. Thanks very much.
Great, thanks Andrew. Good morning, afternoon, evening, everyone. Welcome to this program, to this taster session that on the bank governance, Oxford Bank Governance program. Delighted to see a lot of you here. Please, if you can, turn on your videos so we can have a more engaging discussion. I see Kern as well over there, and I let him. I hand over to him in the second part of the session today, so we split them up. Just before we start today's session, we thought it would be good to have a conversation around a very topical issue, of course, climate risk and climate change mitigation in banking, and the role of banks, the role that financial institutions play in transitioning the economy to a more lower carbon environment, and also to enable businesses to achieve their net zero targets. And in that environment, I also want to talk a little bit about the risks that financial institutions are exposed to, of course, in relation to climate change, and also hear your opinions about what those risks are, how you manage those risks, and what the challenges are that you're dealing with. And this is just a kind of an initial step to set the scene. And if you are going to join the program later on in June, we'll have dedicated sessions on this with our faculty experts as well, in particular on climate change and the risk management tools with respect to how to manage climate risk. Just briefly, as I mentioned, so my name is Amir. I'm the program co-director with Kern. I'm a faculty member at Oxford Business School in financial reporting, capital markets, dealing with financial and non-financial reporting issues, as well as regulatory interactions with regulatory capital requirement for banks and financial institutions. We have also Miriam on this call and Andrew. You've seen Andrew, and if you have any questions, regarding the program or the next steps from here on, please email Miriam. I'm sure you have already been in contact with Miriam. She's been instrumental in setting all this up, and Andrew, of course, as well. Their emails are on the slides. But also feel free to contact me or Kern directly if there are any questions. Given the time constraints, I'm going to just jump right in. Just a couple of you have been in some of the webinars as well, where we discussed the program. So I'm not going to go over the program, the July program, fully again, but just give you briefly, again, a brief outline for those that haven't been on those webinars, and then jump right into discussing climate risks, and then hand over to Kern, who will talk about some of the regulatory trends in respect to climate change and climate risk, and how bank supervisors are looking at this issue. At any point in time, please feel free to jump in, either raise your hand virtually or in the video. I can see some of you if you have your videos on, or just speak up. This session, as with all our kind of regular teaching sessions, as we would teach in Oxford, we'll keep them interactive, and they live from interactions of the participants. Great. Okay, so as I said, just briefly, some of you know this. So this is going to be a 5-week program, well, 4.5, where we'll start with leadership and strategy issues with regards to bank governance or the management of a bank. Rachel will kick off with sessions on trusted leadership and how to engage with stakeholders on these issues. Tim will talk more about strategic planning, and in particular also in context with M&A. Colin on responsible leadership, which seems to be becoming more and more important. We'll move over then to regulatory and risk management issues, in particular, also then delving into a little bit more detail into risk management culture at banks and how to build a risk management culture, and then delve into some of the details with Sophie on kind of capital and liquidity management. Then, as I said, there will be a dedicated session on climate risk management with some of the experts that have developed tools in this area, as well as some practitioners that will give their perspectives as well. Moving on then to governance and conduct issues, so everything around remuneration, board of director, and corporate governance practices or setup in general, as well as some details on financial crime and new developments around money laundering and everything that is becoming even more important in this environment. And then we'll essentially finish the program with kind of an outlook, but also more recent trends on digital disruption and fintech, and how banks are more and more engaging with fintech companies that are disrupting the banking environment, and how to essentially set up a strategy to develop some of these new technologies, either in-house or in collaboration with some newer players in this market. And we'll have some practitioners and guest speakers here as well. So overall, kind of a wide spectrum of what we believe is important for bank managers and bank board members and leaders in banking to know in this environment, supplemented with some asynchronous sessions and other sessions in between those, but I won't go into detail of those and refer everyone to Miriam to go into the details. Then what I want to do rather is jump right in and show you this. So this comes from a survey that I've done in collaboration with Bank of New York Mellon. That was back in 2017, but still kind of sets the scene, I think. And this table shows so we surveyed around 242 asset owners and around 400 asset managers. So roughly 25 trillion AUM at that time of the survey. So quite broad range of investors in the marketplace. And we asked them whether climate change poses a risk to financial institutions. We actually asked them whether ESG in general poses a material risk to financial institutions or to different sectors in general. And this is essentially, the table shows you the percentage of respondents, so the investor respondents, how many responded that for the issues in the rows, they believe that those issues are material for the sectors in the columns. Now have a look at this. So just let's focus just on the climate risk. So the impact of climate change on firms, markets, or operations. Who wants to make an observation? Anything that you find surprising or kind of makes sense? Just to kick off the discussion.
Well, it seems to correlate with carbon intensity of the underlying industry.
So Christopher, thank you. Yes, so it seems to correlate with the carbon intensity of the underlying business. So you see the lighter colored squares here are the ones with a higher percentage. And these are, if you look at basic materials, industrials, energy, and utilities, the more carbon intensive sectors. And then on the right-hand or right-hand half of this kind of table, we have what I would call the more knowledge-intensive or service sectors. Now, what is interesting, I find, is if you think of financial services in specific, from my perspective, this is a fairly low number, 43%. In terms of less than half of the investors believe that climate change has an impact on financial services. Do you agree with that? Or do you have any other? Well, granted, I have to say that this is a survey from 2017, so the world has changed quite a bit since then. But even then, we knew already what the developments on climate change I have. Let me just open the chat. Chris in the chat says far too low for financial services. Christopher also as well, scope 3 of financial is the rest of the economy. Yes. I mean, you're supplying funding for the rest of the economy. So exposure is probably larger than this. But this tells you something around how initially the market has thought about climate change and climate risk. Initially, it was all about the direct effects and of the most polluting businesses. In particular, it was thought of more of a regulatory risk, because those are the businesses that are more exposed to regulatory change in this area. And I'll talk about this a little bit more. So it seems, at least to me, this was a surprising finding. So then let's think a little bit more about what is the risk to financial services and why is this such a big issue. And just to give you the counter view of another survey, this comes from the World Economic Forum. They do an annual survey and set out the global risk landscape, and the one from 2020. So survey is published usually around April, and the new one is actually out, but I'll show you this one because the new one obviously will be highly affected by COVID, perceptions on COVID. But here you can see, so this is essentially a survey of business leaders in financial services, but also broader, as well as investors, around the largest risks. And here on the left, on the y-axis, is the respondents were asked to rate those risks between 1 and 5 on their impact, on the severity of the impact. And on the x-axis, they were asked to rate those risks on the likelihood of occurrence, how likely it is that those risks occur, 5 being the most likely. And what you can see here, top right-hand corner, are those risks that are considered to have the highest impact and also be the most likely. And look at that. Green here being environmental, blue economic, red societal, and then we have technological and geopolitical. And it looks like the right-hand corner is mostly populated by green. And in particular, climate action failure and extreme weather events, biodiversity loss. So generally, it seems that the biggest risks in the minds of investors and businesses in general are considered essentially environmental, in particular climate action failure. So, and this is now obviously fast forward 2020 and compared to the survey results that I showed you before in 2017 and the broader respondent universe. But it shows you how the world has changed and also how these risks are now considered the most impactful and the most likely. Now, as I said, the new survey has come out and the infectious diseases square has moved a lot more to the right top hand corner. So this is, of course, it's always considered these surveys pick a time sensitive or time conscious risks that are at the forefront of their minds of the response at that point in time. But climate risk has, if you look at the surveys over the years back, essentially since 2016, 17, been essentially in the top of the business's minds. So then a question to you, and I hope this works. What do you consider the largest risks stemming from climate change? If you think of this in terms of your organizations. And if you can, please name 3. And here, what I would like you to do, if you have your phones or you're sitting in front of your computers, open your browsers, please. Go to menti.com, so www.menti.com. And then it's a fairly blank page. You can type in the code 30882431, and you should be able to type in your answers in that website. I hope it works. I'll go try it out. But if it doesn't work, let me know. And hopefully we will get some responses here. Let's see. Does it work? Let me see if we can activate it. It should be active. Any response? Does it work? Or can you type in? I don't see anything. Okay, maybe it does not. Christopher, you wanted to say something?
It says to wait for the presenter to show the next slide. I don't know what that's supposed to mean, though.
It shouldn't actually. Should be activated, but oh yeah, here we go. Okay. I see responses already coming in. Okay, that's good. So it seems to work. 5 responses. If you can see the website and can type in your responses, great. Please respond some more. So what do we have? Physical, transition, responsible, greater geopolitical risk. Okay. Evolution of disease, climate security, credit. Okay. So there's a few responses. I'll wait a few more seconds. Okay, maybe for some it might not work, but that already gives you some ideas. So we have 2, in particular, 2 terms here that are essentially exemplary for how we would define climate risk in general, and in particular for financial institutions, is the physical and transition risk. And let's think about these more. So what are the physical and what are the transition risks, and when do they actually play a role for financial institutions in particular? And in how far are they different? And in how far is the impact different if we think about certain scenarios over the future? So let me show you what I mean by this. So these are the projections, the warming projections from, I think, this Climate Action Tracker. We are here 2020, and these are the baseline projections are 4 to almost 5 degree increase is the baseline with no action taken. The current policies are around give us around a 3 degree increase by 2100. With the pledges and the current target, so these are Paris Agreement pledges, we scientists say we achieve 2.3, and then net zero, the new net zero targets, if they are implemented and achieved, give us around 2.1, and then obviously 2 degree consistent, we would have to engage in even further reductions of carbon emissions and the carbon concentration in the atmosphere. So now, if we think of physical and transition risk, these are actually pulling into 2 different directions. And what this means is no matter where we are going, so whether we are achieving a decrease in greenhouse gas emissions as we would hope to, or whether we are going the opposite direction with essentially the consequential warming with it, we will see some additional risks in this area. So, and it's either going to be a more severe physical risks that financial institutions have to deal with. So anything from climate and weather related events, or if we are moving in the right direction with the net zero targets and the attendant policies to achieve those targets, we will see a much more aggravated transition risks. So risks that come from essentially the transition to the lower carbon economy through new regulation and restrictions in the emissions. So either way, there will be new risks that we need to deal with. It's just which ones are more severe in this spectrum. And there will be physical risks in both ends. Now, if you think about this, does this, for those who had transition and physical risk in mind, and then we can talk about reputational and legal risk as well, that come on top of this. Is this how you think about these? So do you see kind of a different spectrum of severity of these risks depending on which direction we move? And do you see a different impact of these risks on your organizations? So in other words, do you believe physical risks to be more severe than the transition risk, or vice versa? And if so, why? Let's hear some opinions. Any opinions? Anyone wants to chime in? There are opportunities, and we will talk about opportunities. That's true. So generally, and when we talk about climate change, we obviously talk about the risks of climate change, but there will be opportunities in terms of new demands, shifts in demand, and also new product and requirements, in particular for transition. And that's what Christopher also says is more likely for transition. The transition requires a massive shift in funding towards more lower carbon products and production processes. And those require essentially the products, the availability of products and investment opportunities. And this is an opportunity, I think, for financial institutions, and I will show you where the trend is going if we have time as well. Chris says more difference in impact and reaction within Europe. That's true. So Southern versus Northern Europe. And in general, we can even break that down further down on the corporate level, where certain companies will be more exposed to physical risks and more sensitive to physical risks. If you think of agribusiness or energy compared to others, and certain companies will be more exposed to transition risks. Any other suggestions? Any other comments? So in thinking of climate change risks, we would essentially think about it as physical, transition, and then reputational and legal risks. And these different risks we can break them down into a lot more granular risks. And in particular, if from a financial institution, from a bank perspective, the physical risks are the ones where you would think about what the effects would be on debt and equity investments or debt financing. So here, everything that is changing the debt repayment capacity or cash flow variability of businesses. So these can come from demand shifts because of the physical impacts of climate change, efficiency and output reductions. There will most likely be higher operating costs for certain businesses to counteract those effects, higher investment needs, increase in insurance costs, and maybe even the lack of availability of insurance. So the uninsurability, and we've seen that some of these businesses that are affected by in that are, and also real estate that are in flooding areas, have essentially no option of achieving insurance anymore. So insurance companies are leaving the market, and we'll have different effects on other products or structured products that are trying to risk mitigate or a risk share, and others. And of course, there will be the direct operational risk for banks as well, if your operations or supporting services are in areas that are susceptible to climate change. So we can think of these as direct and indirect effect: direct on the bank itself, but indirect through, of course, the lending arrangements and the equity investments. And for each of these, we could spend hours to think about how to engage with these, how to mitigate these, and what the actual effects will be. And we will talk about these in much more detail in those sessions in July. Transition risks come from changes in regulation, and I'll let Kern delve more into detail in those, and the policies, as we have talked about these, and additional costs that come from essentially restrictions in production, but also can come from shift in consumer demand and tastes. But again, as Christopher has mentioned, there are also opportunities that arise from this. And we have reputational risk, and I can show you examples of these where we have seen increased activism from investors on and NGOs in trying to push banks to disclose their lending arrangements, or even reduce their lending arrangements to more carbon intensive industries. And I've seen some academic research that looked at also depositor shifts. So we've seen that even depositors are becoming more active in this area, where it's particularly in the US, where banks that have been engaged in funding certain pipelines in those states where those pipelines were going through, we have seen a shift in deposits to banks that were not engaging in the financing of those pipelines. And there's quite measurable effects on those. And of course, there's always the reputational risk in terms of how, as institution, we are pledging to address those risks in terms of disclosure, but also in terms of actual actions, and if those actions don't align with those pledges. And there's examples that we can go through as well. I will just skip this, but just show you the actual physical risks, that these are not future risks, but these are actual already real. Some of these are realized, and this just shows you just some data over the years. Of course, the graph looks like exponentially increasing because it's showing cumulative economic damages, but it shows you that the damages from different weather-related events, so the green being extreme weather, so mostly hurricanes and storms, and then extreme temperature and some flood. So flood and storms and winds are the biggest contributor here. But you can see, and this graph the calculation stopped in 2017. It's around 2.3 trillion US dollars in already occurring damages. So you can see the direct physical effects on businesses are immense, which means the follow-on effects on insurance companies and, of course, financial services cannot be neglected any longer. But just to give you another example of activism that we have seen. So here is just an article from the FT, as well as the Wall Street Journal, and then also on the right-hand side, this comes from an academic study. But essentially, we are seeing more and more investors being active in terms of with shareholder proposals on ESG, in particular climate issues, for usually for corporates, but now more and more also in relation to banks. And Chris Hohn has been one of the most vocal ones, threatening to sue banks. But I think that's an extreme example here. But the right-hand example gives you an example of ESG engagements of a fairly large universal asset owner, in the trillions, the asset owner is managing trillions, and shows you the ESG engagements, in particular on climate, on the environment here that I highlighted in the red box. So you can see that on climate change, this asset manager has had 156 sequences, so 156 separate engagements. So these could be either voting on, also proposing proxy statements on annual meetings, or private meetings with management of those institutions on issues related to climate change and the environment. And there's more on environmental management, 221. So, and this study has been done in 2015, so I had data until 2014. Those engagements have increased dramatically. So we see a lot more activism in this area on, in particular, environmental issues. And we will talk about this as well in much more detail. What is interesting is that there's then also a lot more pressure on financial institutions to disclose their risks. Now, and this has been, again, coming back to the table that I showed at the beginning, there's been a discrepancy here in terms of the climate risk perceptions and the climate risk disclosures. And this has been lamented by regulators for a while, but it's becoming increasingly important, in particular because the TCFD requirements, so the Task Force for Climate-Related Financial Disclosures, are becoming sort of the de facto blueprint or underlying framework that national regulators are using as their climate risk disclosure requirements. So these are more or less becoming mandatory. In the UK, it's already has been decided that these are essentially the mandatory requirements for firms. The EU is incorporating kind of these as their requirements into their regulation as well. But we can see, so this is from a FT from March last year, that this ECB president lamented and criticized that of the 26 biggest Eurozone banks, only 5 actually provide even partial information on climate change risks, and none of them provided full disclosure. So there's immense pressure on financial institutions to improve their risk disclosures, and in particular in relation to climate risk. And this is becoming an increasing issue for institutions, and also a challenge, because even if as an institution you want to disclose, getting the accurate information on your exposures is becoming increasingly difficult. In particular, think about trying to find out your exposure in all the lending arrangements. Firms are not really disclosing at the moment in a standardized fashion those risks that can then be incorporated in your institution's risk disclosures. So this is where the trend is going. There's a lot more that we can discuss on this, and I've been kind of rushing through this. There's and happily talk about opportunities as well, but I think some of these and we will come back to these. There's massive growth in funds that are dedicated to ESG issues, in particular to climate change. There's a massive increase in demand for climate or green products. And just to finish off with some of my own research in private banking, even also in private wealth management, there has been an increasing demand for green products. And this just shows you, this is just a graph of that shows you the incremental flows, investment flows at one particular private bank for which we were able to get data on the client level data. It shows you the incremental flows, cumulative flows into higher rated ESG assets, in particular on the E, compared to the lower rated assets. So there has been a dramatic push towards and demand towards high ESG assets also from private clients. And this trend has continued, in particular also during the COVID crisis, which essentially provides a great opportunity for banks to supply those products and to be part of the transition to a lower carbon economy. I will stop right here. I will come back to questions at the end, after Kern, and then we can discuss some of these issues in more detail. But I want to give Kern the opportunity to talk a little bit more about the regulatory environment that also plays a role in this. Thank you very much, Kern. I'll let you.
Great. Thank you, Amir. And also thanks to everyone for joining us today. It's great to see so many of you out there participating in this event. A taster session as we described it. And what I'm going to do is talk about some of the recent regulatory initiatives in the EU and regarding climate change, but also ESG risk more broadly, and how regulation has now actively begun to incorporate ESG risk into financial regulation across all sectors of the financial industry. And of course, the UK, this is very relevant for the UK because the UK is in complete alignment with this EU legislative framework. It's called the Action Plan on Financing Sustainable Growth. The UK, of course, left the EU, unfortunately, for some who believe in the internal market and financial services a few months ago, but yet the UK in financial regulation is very much aligned with EU regulatory development. So this is very relevant for the UK. Also Switzerland, where I'm based at the University of Zurich, is moving in the direction of incorporating sustainability, broadly defined environmental, social, and governance risk into financial regulation. And so, and although it's not as far along as the EU is, there are a lot of recent regulatory initiatives that are showing that the regulatory pendulum is changing in response to what's going on in the markets. So the markets themselves, investors demand more information. Issuers want to issue products that they define as ESG compliant. And therefore, but there's no definition, there's no standardization about how market participants are defining what is classified as ESG. And so there's some need, there appears to be, because of having more standardization in the market to promote a more level playing field regarding the definitions used to define what is sustainability and what sustainability risk might be in the market, why they're relevant for financial service practitioners. So what I'm going to do, I'm going to talk about, there's the overarching EU action plan that I'll just mention very generally at the beginning. I'll go into a little bit more detail on the EU taxonomy. One of the key pieces of legislation in the EU is the taxonomy regulation that took effect in July 2020. And then there is the other key legislation that took effect last month in March of 2021, the Sustainable Finance Disclosure Regulation, which is now binding, but it's got kind of a phased in implementation period until the end of this year into early next year. And so I'll have, and that, now what very generally, I talked about this overarching EU policy, right? Well, there are four main pillars of the EU sustainability policy. One pillar is under climate and energy, which focus very much on promoting more efficient production of energy in the European Union. There's a strategy on the adaptation of the European economy to climate change and regulating the energy industry to achieve that objective. Another pillar is the environment pillar, and this deals with issues of natural capital management, air, water, land, biodiversity, the so-called circular economy. The third pillar is investment and growth. And this is about promoting investment plans for infrastructure investment, not just large scale projects, but more so-called intermediate scale projects. And the concept of blended finance has become very important in this area, where state, local actors provide guarantees on the downside risks in order to entice investors to invest in medium-sized infrastructure projects in Europe. And then there's other, as part of investment and growth, there's investment in human capital. Horizon 2020 is a research initiative by the European Union universities in Switzerland to generate more research capacity in the area of sustainable investment and growth. And then finally, the pillar that I'm talking about, really that's more relevant for our discussion, is sustainable finance. And this is where the European Commission has adopted an action plan to promote sustainable finance, because they feel there's a need to have a minimum level playing field for regulation and policy regarding sustainable finance in the EU market. The EU market is based on the internal market for goods, services, products, and people. It's a free market, just as like the US is a free market for internal US trade, the EU is a free market for internal EU trade. And very similar legal framework applies. And so, but what the EU is concerned about is that the regulation of sustainability in the financial sector is very disparate. Different member states have different approaches. So the Sustainable Action Finance Plan is about making this more harmonized, having a more harmonized plan for investment. So this is kind of a timeline for the sustainable finance pillar, which started back on the Paris Agreement, was adopted in December 2015. And then after that, a high-level expert group on financial services was appointed to draft a report. This high-level expert group consisted of senior regulators, senior bank presidents, and investment asset management industry leaders, and they produced a final report on how to promote a more harmonized regulatory approach for sustainable finance in the European Union. And then based on that high-level expert report, then the Commission proposed the action plan on financing sustainable growth, which has led to a number of legislative proposals. And I'll talk about two of them in a bit more detail: the taxonomy regulation and the sustainable finance regulation. And so now this is still so the sustainable finance initiative consists of 8 different legislative areas. And they're kind of summarized here, and we'll make these slides available to you later. For instance, one legislation is developing an EU sustainable taxonomy. That's the regulation on taxonomy I talked about, which is about defining what sustainable economic activity is. And then there's also draft legislation for creating standards and labels that are harmonized across the EU, fostering another legislation fostering investment in sustainable projects. And another initiative is incorporating sustainability into financial advice. So when financial advisors give advice on financial products, they have to be able to define and discuss measures of sustainability in those products. And then also there's separate legislation for developing sustainability benchmarks. So how to regulate ESG benchmarks, which are become very important now because asset managers now want to know more about what asset classes are sustainable, which ones are not. And then also there's integrating ESG ratings and market research into sustainability ratings. So the ratings industry will be regulated for ESG, how they depict ESG risk. And also there's new legislation regarding institutional investors and asset management duties. Part of their fiduciary duty to their beneficiary investors will be to give them options and choices regarding ESG investment products. And then one area, banking regulation, which I'm not going into in detail, but still it's very relevant for bank capital regulation, is integrating sustainability into prudential capital requirements, which will now be done under the capital requirements regulation, but only after the European Banking Authority adopts technical standards to define how sustainability risk can be implemented into bank capital measurements. And so there, the big issue is a so-called green supporting factor. Should there be one? And the commission has not yet decided on that, and they've got consultation with industry going and with regulators at the moment. And then finally, fostering sustainable corporate governance is an overarching policy of the Sustainable Action Finance Plan, and there's legislation going into effect to promote that regarding EU company law, as well as in securities capital market regulation. And so now, more specifically, the four most important pieces of legislation that either have become law or about to become law is the taxonomy regulation, which sets out criteria to determine the environmental sustainability of economic activity. And then there's the benchmark regulation, which is a proposal to amend the current benchmark regulation. This was done in 2020, which creates a new category of benchmarks containing low carbon and positive carbon impact benchmarks, which will provide investors with better information on the carbon footprint of their investment. And then what I mentioned also, the sustainable finance disclosure regulation, which introduces consistency on how institutional investors and asset managers will integrate sustainability into investment decision-making processes, and also to increase transparency of sustainability risk to investors. And then finally, the fourth box is incorporating sustainability into financial advice. So under the MiFID II or MiFIR regulation, the regulation of financial products will require that those products have information for clients about sustainability risk, about and how they're measured. So that will be as part of amendments to the MiFIR regulation on the distribution of financial products. So those are four main areas where the law and the regulation have now really started to change. What I want to look at really in more detail is what is the basis of these 8 areas of regulation is the taxonomy. It's a dreadful word, taxonomy. It sounds like a terrible scientific experiment, but generally it's a classification or a list of economic activity that is considered environmentally sustainable. And the second, now what it is not a mandatory list to invest in or not, nor is it a standard about what is not sustainable, nor is it an exclusion list that investors would, blackball and not invest in. And it does not intend to harmonize existing market practices and strategies in the EU with regards to sustainable finance. Basically what it is it's an aspirational list of economic activity that the European Commission, based on scientific advice from a technical expert group, they define certain areas of the European economy as environmentally sustainable or green or ESG compliant. Now still that's a lot of, that's a big signal to the market. Why are they doing this? Well, the EU has an objective of having a harmonized list of economic activities that can be considered environmentally sustainable for investment purposes. And they want it to have, they were concerned that there were disparate market practices across different member states. There were different regulations on this. There were different market practices regarding what's sustainable and what is not. And they decided, because it's the internal market, they wanted to have a harmonized single definition of what they thought was sustainable, but not a legal requirement to invest in sustainable sectors, but more as an information signal to the market about what sustainability was. And so the taxonomy regulation basically is one part of it, an important part of it is based on 6 different areas of environmentally sustainable economic activity. And at the bottom of this slide, those 6 areas are climate change mitigation, climate change adaptation, sustainable use and protection of water and marine resources, transition to a circular economy, and pollution prevention and control, and protection of healthy ecosystems. So those are the 6 areas that you define as being environmentally sustainable or not. And if the economic activity promotes one of those 6 areas, then it can be defined as environmentally sustainable, and therefore go on a green list. You might call it a green list for investors to decide. Now this list of sustainable economic activity is not static. It is dynamic. It is intended to evolve over time. And so the European Commission is delegated authority and discretion to draft secondary legislation that will redefine the sectors of the economy that are sustainable over time, to include more sectors that meet the scientific classifications that are set by the technical expert group. So the European Commission will refine this definition on an ongoing basis. Now, the benefits business-wise for this are that it provides a definition of environmental sustainability across the whole EU where there was none before. It helps indicate whether activity is sustainable or not. And it's for market participants to decide whether or not they invest in sustainable or non-sustainable activity. There's no penalty, no economic cost to pay other than what the market may impose. And it basically does away with the problem of gray areas where something's a little green or a little not green. So this is, you can go over the slides a little bit later and think about the benefits of this, but it's meant to standardize the definition of ESG risk and to kind of nudge the market in a particular direction with signals about what sustainability is. And these are key features of the taxonomy regulation. It reflects technological and policy developments. So the technical expert group will update the definition from time to time based on delegated powers that the European Commission has. They will build on existing market practices and existing initiatives. What's not green is not necessarily brown. It's just simply not green. There's not a brown list. There's just a green list. And it will facilitate the transition of investment, in theory, from polluting sectors to lower carbon sectors. And it's technology neutral. Now, briefly, I know we want to leave some time, just a couple of minutes on the sustainable disclosures in financial financial advice and also for corporate issuers. Disclosures of sustainability risk have been disparate across the EU. Different countries have different standards. And therefore, the goal here is to have disclosures on integration of sustainability risk and impacts on financial products should be harmonized. The disclosure requirements, and also there should be explicit questions on sustainability built in to the suitability test that financial advisors have to conduct regarding their clients, whether professional clients or retail clients. So this is meant to provide more harmonization in what they have to disclose to customers and clients regarding sustainability risk. And so the key objectives in the Sustainable Finance Disclosure Regulation are transparency and comparability, overarching. And then the subjected entities are financial market participants like banks, financial institutions, insurance companies in their design or manufacturing process of financial products. And also the subjected entities are financial advisors. So they're subjected regarding their investment advice or insurance advisors as well. It applies to the insurance industry. They have to have these sustainability disclosures on their websites, and there has to be transparency on their websites regarding the principal adverse impacts on investment decisions. The provisions of the sustainability directive apply at the financial product level. At the pre-contractual level, there has to be transparency on what sustainability is, what it is not. There have to be ongoing ESG disclosures on bank and financial institution websites, and there has to be periodic reports on ESG risk regarding for issuers to investors regarding the ESG disclosures. Now, company disclosure is also affected, not just financial company disclosure, but general. The taxonomy regulation requires companies to update and enhance their disclosures based on an earlier legislation that was the non-financial reporting directive. So that's now been upgraded to be more expansive regarding just any company that's listed on an exchange that has its securities chain listings. So there's broader disclosure, not just financial sector, but also non-financial companies, and also financial market participants have enhanced disclosure, as I mentioned before, and the technical screening criteria that they must use for determining sustainability or not. This will be updated over time by the technical expert group of the which advises the European Commission. And then finally, key challenges in the future are it's the raw data relating to sustainability indicators. How do we measure it? How do we collect it? Management strategies for collecting and understanding, interpreting it in the analytics. Amir had mentioned that earlier with some of the issues in the survey data he had conducted. And then there is the challenge of having harmonization and implementation of these new legal and regulatory issues. And this is very much a part of transition risk, what Amir had mentioned earlier. And this is just that the final slide is the timeline. The timeline for the disclosure regulation. It's become legally effective earlier this year, but the final implementation of disclosure activities or have to be done over a period of stages all the way until the end of 2022. So this is just a little roadmap for what companies can expect to do over the next year and a half. So the transition risks are there. You see the legislative and policy changes in the EU to try to align investment decision-making with sustainability risk and sustainability criteria. And it poses challenges for banks, investment firms, and insurance companies. So thanks very much for listening. I'm happy to take any questions.
Thank you, Kern. We know that we are approaching the hour, but I think, well, Kern and I are happy to stay on for a little bit longer and answer any questions. If there are any questions to the topics we discussed, anything in more detail, or to the program itself, please feel free to shoot. We are here to answer any questions. And Andy is online as well.
Can I ask a question?
Oh, of course, Fotis.
Yes, I really like the presentations because in a good synopsis, I understood what needs to be done. My question coming from the board of an investment bank is, should we have already done something, or is this something that we need to do, let's say, within the year? I wonder whether we missed some deadline related to requirements stemming.
Oh, I think you muted, but I think we understood the question. So,
well, I might just say that if Fotis is coming from an EU state or a European Economic Area state, these are now new requirements on the books for disclosure. So you need to have a plan for how you're disclosing sustainability risk in the sale of financial products if you're an investment bank and you've got professional clients or retail clients under the new MiFID II framework. You also will have these disclosure requirements for issuing companies, non-financial companies, as part of the updating of the non-financial reporting directive. So these are things that investment banks or asset management companies need to be doing now. They've got kind of a deadline of some of the requirements or have to be done by the end of this year, and some of them have next year regarding disclosure, the disclosure requirements. And then and other requirements will come on board in the next 2, 3, 4, or 5 years.
Yeah, and I think, and beyond the disclosure requirements and the regulation, in terms of the business opportunities and the management of risk, of course, so banks have already thought about this, as you know. You've been thinking about climate risks already for a while, but I think over the years we have become more and more aware of how to starting to quantify these risks and the impact of these risks to be able to manage them. And I think more and more banks are increasingly integrating climate risk into the risk management framework and into the corporate governance. So it's becoming a board level issue, and rightly so. And I think, I mean, to answer Forte's questions, it's never too late. So I think the market is actually now beginning to expand quite dramatically, and the regulation is coming in together. So there's a perfect storm coming in, and I think now is the time to act if you haven't done so already. And there's certain requirements, in particular with the TCFD, also in relation to corporate governance in countries that require action to be able to achieve those deadlines that Kern mentioned, essentially beginning of next year and then the following year.
Yeah, I think if I just may, I think it also probably depends where the bank is operating here. I mean, I'm working in a bank, we are SSM bank, so regulated by the ECB. And we had like SFDR is something that we had to comply with already. We are now working on the ECB guide on climate related risks. So this comes in force in June. Loan origination guidelines from EBA come in June that also tackle this area. And it's like a regulatory tsunami. So, we had to submit already a questionnaire to the ECB there. A new questionnaire is due in May. So we have a lot on the table here, to be honest. So, and we are anyway late. I mean, like if you look at some of the maybe bigger banks, leading banks like BNP, ING, I think they're on the forefront. They already have a lot here. And I think this disclosure is also this. There is a non-financial disclosure regulation under which many institutions disclose already a lot of things here. So I think it really depends probably where you are, but it's for everyone something to do.
Yeah, absolutely, and in particular, in Europe, as you say, it's a big issue, and there's a lot going on, in particular if you're in the Eurozone.
And if you're a bank distributing financial products, it's really a strong business case to be made to think about how you might incorporate sustainability into your business plan, because clients, customers, banks, their preferences and attitudes are shifting to sustainability, and so the regulation is sort of moving this way, but also there is growing demand in the marketplace at the retail level as well as institutional level regarding investing in sustainable assets. And Amir's slide on the growth of the amount being invested in sustainable asset management funds is really the trend in the market. So it's part of getting ahead of the business curve as well as the regulatory curve.
And that actually leads to Sashio's question, asking in the chat if we see new business opportunity for banks and insurance in the insurance space to collaborate for sustainability initiatives as a finance industry. So essentially, are there new business opportunities? And this is, as Karen mentioned, we see this already, right? So ESG funds or fund offerings are essentially have seen a quite dramatic rise, but that's one side is the fund offering. But if you look at debt markets and structured products on sustainability, there's quite a lot happening there as well. So green bonds, of course, have seen quite dramatic growth, although 2020 was the growth that slowed a little bit. But still, there's been a lot of growth on green bonds, and in particular now on sustainability linked instruments. And here sustainability linked meaning in as opposed to green bonds where the proceeds are usually promised for green investments. So the bond itself is just a regular bond issued, and the proceeds have to be invested into some green investment. Sustainability linked bonds is where the return on the bond is linked on a sustainability target. So this could be, I don't know if you've seen, for example, what was it? Chanel late last year issued a sustainability linked bond, 300 million issuance, where the interest rate on the bond was fairly low. I thought it was fairly low, but there was a bonus payment if Chanel doesn't achieve certain scope 1 and scope 2 targets on their emission reductions. And that's quite interesting. And there's other examples of this linked to climate finance, but also linked to other sustainability issues such as access to medicine and others, and low income products or products for low income constituents and so on. So we see a lot more sustainability linked products as well. And I think the third area, just to finish this off, is in the regulatory capital space. I think there's a lot of, I've seen increasing transactions where you have essentially green reg cap transactions, where you have securitizations that are there to reduce capital requirements for banks, to free up capital for green investments, or to use green assets that are securitized for investors to satisfy investment demand. And this could be cash, so physical asset, but also synthetic transactions, so CDS-based transactions that we have seen. So there's quite a lot happening in that space in terms of innovation as well, and we can pick up some of this in discussions in July as well. Any more questions? Anything else we can discuss? I'm aware that we are over time, but as we said, please feel free to also just contact us directly, email us. Our emails are on the university websites, and otherwise we will share the slides as well, and then we can put our contact details on there as well, and we can pick up discussions offline as you wish. Andy, did you want to have some final words?
I'll close this out. Thanks, Amir, and thanks, Kern, and thanks everybody who joined us this afternoon. Really appreciate you taking the time out, and hope you found the discussions and the presentations useful. The recording will be shared around, so we will distribute this to all of you to kind of review and go back over. And as the guys mentioned, we're happy to kind of circulate the slides as well if those are useful for you all to see. And if any other questions, our contact details will come around with the email, so do feel free to reach out to us for a chat if it's useful. Otherwise, hope you have a great rest of your day and rest of your week, and we hope to see you all again soon. Thank you so much.
Thank you, everyone.
Cheers. Bye-bye. Thank you.